As of the close of regular trading on Wednesday, June 17, 2026 at 4 p.m. Eastern Time, Navitas Semiconductor stock settled at $22.34 per share, marking a modest upward move of 1.14% during the session. While a flat or slightly positive day might make it look like the dust is settling, what most people are missing is that this quiet tick upward happened right on the heels of massive institutional volatility, a sudden executive shakeup, and a massive $500 million financing program that completely upends how this company plans to scale. If you are watching this company through standard retail screens, you are likely missing the quiet tug-of-war happening behind the scenes between short-term capital dilution and long-term infrastructure demand. The immediate surprise here isn't just the price movement, but how the underlying volume tells a story of aggressive accumulation by larger institutions, even as casual retail participants scramble to understand the company's unexpected boardroom exit. The common ground with this asset has always been straightforward. Most market participants look at it as a high-potential microcap play tied to the broader silicon carbide and gallium nitride markets. The standard expectation is that as massive data centers scale up to handle immense computing loads, smaller niche power management chip makers will naturally ride the coattails of the giants. But the reality is far more complicated and far more interesting. This isn't a passive ride on a rising tide. The company is in the middle of a massive structural pivot, moving deliberately away from its historic reliance on consumer mobile chargers and low-margin smartphone accessories to fight for a spot in megawatt-scale infrastructure. This shift creates a massive gap between what casual investors expect and what the financial reality dictates, creating an environment where a single capital raise can trigger massive swings that shake out weak hands while sophisticated players reposition their portfolios. When you look across the popular investing sites and retail apps, you see a lot of chatter about whether this asset belongs in a self-investing strategy or if it is too volatile for an individual brokerage account. If you track how retail volume moves on the Robinhood app or through standard Robinhood investments, the focus is often on daily price spikes and social media momentum. However, looking at the recent trading data, the true story is found in the massive institutional blocks clearing through platforms like the Interactive Brokers platform and high-end Fidelity brokerage services. Just a few sessions ago, the stock experienced massive swings, surging up past $30 before pulling back sharply to its current alignment near $22. This intense volatility was directly triggered by two massive announcements: the launch of an advanced ultra-high voltage power package aligned with high-power industrial uses, alongside a $500 million at-the-market equity program. An equity program of that size for a company with a market capitalization hovering around $5 billion is a massive event. It means the company can systematically issue new shares to raise capital, which naturally brings the threat of near-term dilution. To a casual trader looking at their Robinhood stock trading account or managing their portfolio through the Fidelity mobile app, a $500 million share printing press looks like an immediate reason to hit the sell button. This fear of dilution explains the rapid drop from the $30 peak down to the low 20s. But if you look deeper into how institutional desks utilize an Interactive Brokers account or deploy capital through sophisticated Fidelity wealth management strategies, they often see these capital raises as essential fuel. High-power chip manufacturing requires immense upfront capital for fabrication, testing, and scaling inventory. By securing $500 million in flexible funding, the firm is ensuring it has the balance sheet strength to fulfill massive upcoming orders without running out of runway. At the exact same time this funding mechanism was filed, a key director and former head of the executive steering committee resigned immediately. In the world of online investing, an unexpected board resignation right alongside a massive capital raise usually triggers immediate red flags. This is where the tension between expectation and reality becomes incredibly sharp. The expectation is that internal conflict or looming financial trouble is driving the exit. The reality, however, appears to be a deliberate changing of the guard as the firm transitions into its next operational phase, brought to light by their recent recruitment of veteran semiconductor executives from massive industry mainstays like Broadcom. This structural transformation shows that the company is actively preparing its leadership team for large-scale corporate execution rather than early-stage research and development. If you are using tools like Schwab Intelligent Portfolios or exploring specialized Fidelity ETFs to build a diversified position, understanding these granular movements is vital. The broader sector momentum is heavily skewed by what is happening with megacap names. Everyone tracking Nvidia stock, Tesla stock, or Apple stock knows that the hardware demands of the modern enterprise are changing. But while the main headlines focus on the primary processors, the real bottleneck is shifting toward the underlying electrical infrastructure. A high-performance computing cluster cannot run on standard silicon power architectures without melting or wasting massive amounts of electricity. This is where gallium nitride and silicon carbide materials become critical, as they allow electrical power to be converted and delivered at much higher efficiencies and in significantly smaller physical footprints. Recently, the company confirmed its active collaboration within the specialized Nvidia MGX architecture ecosystem, specifically focusing on building out power delivery infrastructure for megawatt-scale server racks.
When this news originally broke, it sent the stock soaring, showing just how desperate the market is for validation in this space. If you manage your own online investment portfolio through SoFi Investing or active trading accounts, you have to look at how these partnerships actually translate into numbers. The expectation was that an official nod from the largest chip designer would instantly guarantee massive immediate revenue. The reality is that entering a major hardware ecosystem involves a long, grueling qualification cycle. The company demonstrated a sophisticated 10-kilowatt power delivery platform that boasts a peak efficiency of 98.5%, which essentially eliminates an entire intermediate voltage conversion stage. That is a massive technical achievement, but turning that technical win into steady corporate cash flow takes quarters, not days. Let us look closely at what this business actually does and how its underlying model operates. Founded to commercialize next-generation power semiconductors, the company focused its early years on gallium nitride chips designed to make smartphone wall chargers smaller and faster. It was a high-volume business, but it suffered from terrible pricing pressure and razor-thin margins. Recognizing this trap, management initiated a strict corporate shift to focus almost exclusively on high-power enterprise markets, including data centers, solar grids, energy infrastructure, and industrial motor drives. Their product line is divided between their specialized high-speed gallium nitride devices and their high-voltage silicon carbide MOSFETs. By targeting these heavy-duty industries, they are chasing contracts that carry much higher sticky revenue and vastly superior margin profiles compared to consumer electronics. Financially, the historical reports show exactly why this transition is so urgent. Looking back at their first quarter financial results for 2026, total revenue came in at $8.6 million. While that represented a healthy 18% sequential growth compared to the final quarter of 2025, it was down from $14 million in the first quarter of 2025. This drop perfectly highlights the pain of their intentional corporate transition. They are actively walking away from old, low-margin mobile phone contracts, which causes short-term revenue declines, while they wait for the high-power enterprise orders to scale up. On a non-GAAP basis, their gross margin did show positive signs, expanding slightly to 39% due to a more favorable product mix. However, the company still posted a GAAP operating loss of $28 million for the quarter. They held $221 million in cash and equivalents at the end of March, which explains why they wanted to establish that $500 million at-the-market equity program in June to supercharge their available capital. Please comment below with how many shares of Navitas Semiconductor you currently hold in your portfolio, or share your thoughts on whether you think smaller power chip companies can survive long-term against traditional silicon giants. Hearing your perspective helps build a much clearer picture of how individual investors are navigating this volatile sector. When you look through popular choices like SoFi stocks, Fidelity mutual funds, or self-directed investment help channels, the consensus often oscillates between extreme optimism about artificial intelligence infrastructure and extreme panic over near-term company losses. If you are executing trades through a Robinhood cash management account or adjusting your long-term allocations using Robinhood fractional shares, the key is to look past the daily noise of retail trading. The massive trading volume we witnessed during the recent drop down to $22 indicates that a substantial amount of shares are changing hands, transferring from speculative short-term traders into the hands of larger players who are willing to absorb the dilution in exchange for a funded balance sheet. Looking forward, the future outlook for this asset relies entirely on how successfully they scale their high-voltage production. There are a few clear scenarios that could play out over the coming months. In the bullish scenario, their direct-cooled thermal management packagers gained rapid adoption among enterprise server manufacturers, leading to a massive surge in order backlogs during the second half of 2026. If these design wins materialize into hard revenue, the current $5 billion valuation could look incredibly conservative, and the capital raised from their equity program will look like a masterstroke of defensive financing. The risk, or the bearish scenario, is that larger legacy semiconductor manufacturers who are also building out silicon carbide capacity could use their massive scale to undercut pricing, trapping smaller players in another margin war. Furthermore, any broader delay in the construction of global data centers would hit this stock exceptionally hard, as they have staked their entire corporate future on enterprise infrastructure spending. Navigating these dynamics requires a reliable framework, whether you are using a basic individual brokerage for quick trades or relying on a structured SoFi robo-advisor for automated wealth management. The clear lesson from recent weeks is that the asset's market narrative is constantly clashing with its operational realities. The market expects a smooth, upward linear trajectory because of the company's proximity to major infrastructure ecosystems, but the reality is a choppy, capital-intensive transition filled with corporate dilution, executive changes, and lumpy quarterly revenue. To bring this all together, the central insight here is that the recent stabilization around $22 per share represents a temporary truce between those terrified of share dilution and those encouraged by structural financing. The expectation was that the company could easily coast on its technical credentials alone, but the reality of building advanced hardware forced management to take aggressive, dilutive financial steps to secure their long-term survival. For individual investors utilizing everything from basic investing sites to a premium interactive broker stock trading setup, this asset remains a high-stakes study in corporate execution. It's a business that has successfully aligned its technology with the largest hardware demands of our time, but it must now prove it can cross the financial chasm from a loss-making innovator to a profitable enterprise powerhouse.